On Friday, October 10th, 2025, the markets cracked. The S&P 500 dropped 2.7%, the Nasdaq sank 3.6%, and the Dow slid almost 900 points. More than $19 billion in crypto leverage vanished in a single day. Gold, meanwhile, broke through $4,000 an ounce, a price no one thought possible this soon. The spark? A single sentence from Washington: effective November 1st, all Chinese imports will face a 100% tariff. But this story didn't start that day. It began a week earlier in Beijing. This is FluxFolio Finance, where we decode what markets fear most: uncertainty. In early October, China made the first move. It quietly expanded export restrictions on rare earth metals and magnetic materials, the minerals that power EV motors, wind turbines, and advanced chips. It was a calculated signal, Beijing reminding the world that it still controls the supply of the building blocks of modern technology. Analysts called it a soft punch, economic leverage without open confrontation. The timing wasn't random. Officials in Beijing were preparing for a possible Trump-Xi meeting at the upcoming APEC summit. Then, on October 10th, Washington fired back with something far louder: the 100% tariff threat. Within hours, screens around the world turned red. The trade war that once targeted steel and washing machines had evolved into a fight over chips, energy, and minerals. Market reaction. By Friday's close, weeks of gains had vanished. The VIX volatility index spiked above 30, a level traders hadn't seen since spring. Oil and copper slipped as growth fears spread, while bond yields swung violently between panic and safe haven buying. Crypto took the hardest hit. Bitcoin fell roughly 10% from its recent peak, while Ethereum lost around 20%. It wasn't fundamentals, it was forced selling. Leverage unwound, algorithms dumped positions, and the digital asset boom turned into a liquidity drain. Uncertainty raises gold price over $4,000. When gold crosses $4,000, it isn't enthusiasm, it's anxiety. Central banks have been buying at the fastest pace in half a century. Investors are no longer chasing yield, they're chasing trust. Analysts now talk about $5,000 gold as realistic if capital keeps fleeing debt and equities. Gold has become a mirror, reflecting every crack in confidence in central banks, politics, and paper money. The last time fear looked like this, the world rewrote its monetary rules. The Fed's paradox. In September, the Federal Reserve cut rates by a quarter point, the first move toward easier policy in almost 2 years. But here's the catch. Its balance sheet keeps shrinking. Quantitative tightening is still draining cash from the system. On paper, rates are falling. In practice, liquidity is drying up. Corporate borrowing costs remain high, and credit spreads are widening again. Markets expected relief. What they got was confusion, easy words, tight money. Global ripple. The shock didn't stay in New York. China's economy is slowing, growth near 4%, prices slipping into mild deflation. Europe is flirting with recession as industrial output contracts. Oil has retreated to the mid-$70 range after touching $90 just 2 months ago. Currencies from Southeast Asia to Latin America have weakened as investors rush back to the dollar and gold. The trade war isn't bilateral anymore, it's global. The bubble check. This sell-off didn't come out of nowhere. Tech and AI stocks were priced for perfection. Crypto had soared to record highs. Optimism had become leverage. One shock, one tweet, was all it took. The correction we're seeing now isn't chaos, it's discipline. The market is reminding everyone that cycles still exist and that liquidity, like faith, can vanish overnight. Where capital runs when trust fade, capital is migrating to safety. Short-term treasury bills are suddenly more popular than tech IPOs. Cash yields 5%, a risk-free reward investors haven't seen in decades. Gold ETFs are gaining new inflows every week. Real estate funds are facing redemptions as commercial vacancies rise and higher rates squeeze buyers. Even in crypto, money is rotating towards stablecoins and away from speculation. When trust fades, liquidity, not leverage, becomes power. The investor playbook for 2025. In uncertain times, discipline beats prediction. 1. Keep at least 15 to 25% of your capital liquid for opportunity and for peace of mind. 2. Favor companies with strong cash flow, real earnings, and low debt. 3. Add a layer of tangible exposure, energy, infrastructure, and precious metals. 4. Hedge risk, don't amplify it. 5. Stay adaptive. Policy cycles now turn faster than ever before. In short, protect the downside first. The upside takes care of itself. What comes next? From here, 3 paths could unfold. A soft landing, where rate cuts calm credit and markets slowly recover. A liquidity trap, where cheap money fails to spark growth. Or an inflation comeback, if tariffs push up prices and force another round of tightening. Which path we take depends on diplomacy, whether Washington and Beijing choose negotiation or escalation, and on confidence, whether investors still believe in the system that created this boom. This isn't the end of the world. It's the end of complacency. Every cycle has a climax and a correction. Every crash clears excess, and every rebound rewards patience. So, is this the end of the cycle or just its reset? Maybe both. But history is clear. Markets don't die of fear, they die of forgetting. Stay sharp, stay thoughtful, stay ahead. This is FluxFolio Finance.